recording. Okay, so yeah, I wanted to welcome everyone to Understanding Financial Ratios. And I wanted to tell you a little bit about SCORE. SCORE offers free and confidential mentoring for those that are starting a business, are thinking about starting a business, or already are in business. Our mentors come from a wide variety of backgrounds and expertise, and they are volunteers and they want to help businesses grow and start. We do have several chapters within the state of Massachusetts in our district, and I will post the link to those chapters in the chat for you. Those websites are a great place to find tons of information about businesses and also a way to connect with a mentor. You can also reach out to me via email, and I will put that email into the chat as well. And I will make sure that the correct chapter reaches out to you to get that mentor. Do you have to be fully organized to get a mentor? No, you do not. We're there to help you get started and help you get organized so that you take the right steps along the way. Most sessions are Zoom in phone right now. We do have a few rare face-to-face, and hopefully we'll be adding more of those as we go along. And most sessions run at around an hour. And you can continue that relationship for as long as you like. Because we do anticipate a lot of people on the call today, it's really important that you post questions in the Q&A tab. We will be stopping after each section to address questions about that section. Q&A tab is on your Zoom bar. Chat certainly for everything else. So I'm going to go ahead and I'm going to turn it over to Johnny, if you'd like to talk a little bit about East Cambridge Savings Bank.
Great. Thanks so much for the warm welcome, Teresa. Good afternoon, everyone. I'm Johnny Long, business banker at East Cambridge Savings Bank. SCORE has been such a fantastic partner for us, and we're very excited to continue our partnership this fall to bring you a new series of workshops. A little bit about East Cambridge Savings Bank. We're a full service, mutually owned bank, and we're committed to being the preferred banking partner in the communities that we serve. And being mutually owned means that we don't have shareholders to be able to report to. We're in business for our customers, our local businesses, and our local nonprofits. And we've been doing that since 1854. We're also excited to announce that we recently finished our acquisition of Patriot Community Bank, and we're excited to bring our 11th location in the Woburn community. And for those that are local, we're having our grand opening and a community day event this coming Saturday from 9 a.m. to 1 p.m. There'll be food trucks, kids activities, and raffles with the chance to win one of 5 $500 cash prizes. So I'm going to say that again, 5 $500 cash prizes. I'm going to include some more information about that in the chat, but we hope to see you there. And now I'll turn this back to Teresa.
Okay, great. Thank you, Johnny. Well, I would like to introduce you all to our presenter today. We have Ramesh Advani, and he is a SCORE Boston mentor. Maybe he'll tell us a little bit about himself as we get started. Go ahead. I'm turning it over to you.
Thank you, Teresa. And thank you, Johnny, for sponsoring this series. We're just delighted to be a partner with you folks. So my background is I have been in the for-profit and the nonprofit and the government sector in many different functional areas, primarily in financial and marketing roles till I moved on into general executive management. And I've been a SCORE mentor for many years, and I'm happy to help a lot of people who are interested in help with nonprofits come to me, but then there are also small businesses in the for-profit sector who I do mentor. So I'm happy to, if you set up time with the Boston SCORE chapter, happy to help you. If after this webinar you want help or to understand this topic even a little bit better for your business, if you're already in business, I'd be happy to also follow up. But having said that, I will go right into my agenda. this topic of financial ratios can be very overwhelming, but I would like to suggest that you just think about this in very simple terms. You don't have to be an accountant or an accounting or a financial guru, as long as you have a calculator even on your computer and you know how to look at a number on a report and divide one number by the other. You just have to know division and multiplication, and you'd be easily able to do this. So I'm going to first give you a high level idea of what are ratios. And there are many, many ratios, but I'm just going to talk about a group of 4 ratios: liquidity ratios, operating ratios, profitability ratios, and working capital ratios. And after each section, I will pause and take any questions that you put in the Q&A or any comments put in the chat. There is a question from Suzette, and you'll be getting answers to some of these broad questions directly. So let's start with what are financial ratios? Financial ratios are little indicators that help you understand how your business is doing. They take information from primarily 2 documents that your accountant or your CFO, or if you do your own financials from QuickBooks or whatever, you could get those 2 documents. And if you open those documents, you would be able to find the numbers that you will need to calculate these ratios. Those 2 documents are your balance sheet and your income statement. So those are the only 2 documents you need to look at. And why do you need to look at ratios? Because in order to understand how well your business is doing, how well it has done in the past, and it gives you an indication on where you're headed with your business. It also provides you with a look at how you might be doing versus your competition. Obviously, your sales and your marketing efforts tell you a lot more of that, but financial ratios are a very, very important look at what's going on with your business in the marketplace. The other broad overall thing I should tell you is when you look at these ratios, you say, well, what time frame should I use? It's very important when you look at any business, which is an ongoing business, you should look at this ratio or a group of ratios over multiple time frames. So you can, a profit and loss statement, for example, is produced for a period of time. A balance sheet is a point in time. So you can look at your balance sheet at year end. What was it like 2 years ago, 1 year ago, or even current? You could look at a profit and loss, pull a profit and loss statement from a year ago, 2 years ago, whatever time frame. And it's important to look at this so that when you calculate these ratios, you're doing it for these different time frames. And why is that important? Because it gives you a trend. The most significant thing you should know about finances, it is a report card that is just telling you how things are going. And from this report card, these ratios give you an indicator. So if your ratios are getting better or getting worse, then you can start to think of what action you need to take. Now, a financial ratio will not tell you take this action or take that action. But when you look at it and you think about it, and I'll go into that in a little bit more depth on specific ratios, you can then say, okay, if I do this, this is what will happen, and this is how it'll improve. but you will be driven by your other considerations, the marketplace, the economy, the competition, your own operations, etc. So you should know that this is not a be all and end all, but it's a way of making business sense out of the numbers that are thrown at you or you look at while you're running a business. So I'm going to go into the ratios now. So we're going to look at 4 groups of ratios. So beyond this, there are many, and even within these groups, there are several ratios. And this is not an MBA program, so don't worry about all those. These are the most important ones that you should look at. So we'll start with liquidity ratios. What do liquidity ratios do? Liquidity ratios, they help you understand if you can meet your short-term obligations using cash that your business has or cash-like assets. What is a cash-like asset? Cash, is the cash you have in your bank account. Cash-like assets are, the business might own some securities, marketable securities that could be traded on the stock market. Another asset that is cash-like, not as liquid, but certainly more liquid than fixed assets, is inventory. So you could sell your inventory faster and generate cash. So some of these cash-like assets are not just cash, but in your balance sheet, they will be at the top of your set of assets when you look at a balance sheet. Now, once you understand this, a liquidity ratio, you will get a preamble, a look at how you can avoid any default or bankruptcy. That's why it's important to look at these. Other people, when you share your balance sheet and your income statement with your bankers or an analyst or a creditor, they look at these liquidity ratios. So I'm going to talk about 2 liquidity ratios. One is called a current ratio, and the other is called a quick test ratio. So just from the name, you can tell it's something that you can calculate very quickly. It's also called by another name, acid test ratio. We'll talk first about the current ratio. So a current ratio, on your balance sheet, you have current assets and you have your current liabilities. When you divide your current assets by your current liabilities, that is called a current ratio. Generally, you want your current ratio to be greater than 1.5 or 2, and that's very good. Less than 1, it means you're not solvent because your current liabilities are greater than your current assets. And if that happens, if somebody asks for their money, you could be in trouble because you don't have the cash or cash-like assets to pay off those liabilities. The second ratio is the quick test ratio. In the quick test ratio, when you look at all your current assets, you subtract out the inventories from the current assets, and what's left, you divide that by the current liabilities, and that's called a quick test. Now, why is this quick test? Because sometimes it's much harder to dispose of inventory because you have to have a fire sale or try to generate the cash, etc., or the market conditions may not allow you to get rid of your inventories. But the other current assets like cash or marketable securities or accounts receivable, those could be converted to cash very quickly. And therefore, it's called a quick test ratio. So I will pause here and see if there are any questions on liquidity ratios.
We do have one question. Credit cards are cash-like or considered debt, so not cash?
That is correct, Connie. Credit cards, when you have a credit card, that's really anything are you borrowing on a credit card or using? It's really like a loan, so it's not cash. Now, sometimes credit cards, you have access to, you have cash, you can get cash on a credit card, but that is still a borrowing and a loan, and that's not an asset. That's correct. Any other questions on liquidity ratios?
I do not see any questions posted at this time.
Okay, thank you. So I'll go to the next grouping of ratios called operating ratios. Now, operating ratios give you an idea of how you're doing in your business. The first ratio is the operating profit percent ratio. Very simple. You calculate it by taking your profit, your operating profit, which is on your profit and loss statement. And if you divide that by your sales dollars, sales or revenues, and convert it into a percentage, that is your operating profit percent. Now, on a profit and loss statement, there are many different lines and types of profit. You look at the line that says operating profit before taxes or miscellaneous income, because what this profit is the profit that you make out of your operations. And again, just looking at operating profit in a given quarter or given year is not enough. You should see what your trend is over time. What was your operating profit last quarter versus this quarter, last year versus this year, so that you can get an idea of the trend. So that is one of the operating ratios. The second one is called the inventory turnover ratio. The inventory turnover ratio, you need the numbers for inventory dollars from your balance sheet, and you need your cost of goods number from your profit and loss statement, from your P&L. So if you take the average inventory dollars on your balance sheet, how do you know what the average inventory dollars are? A balance sheet, as I said, is a point in time. So you look at your balance sheet at the start of the year, you look at the balance sheet at the end of the year, look at the inventory over there, do an average of those two numbers, and then you divide it by the cost of goods in your annual profit and loss statement. Dividing one by the other is your inventory turnover ratio. So just as the words say, inventory turnover, it tells you how often in a year does your inventory gets depleted or needs to be replenished. So it helps you drive your operational activity. If your inventory turnover is too high compared to your competition, so you can't just look at your own inventory turns. You have to look at what's going on in industry. If the inventory turn ratio, for example, let's say for you is 6, but the industry or the competition is 4, it means your inventory is getting used up very quickly. And if that happens, it is giving you an indicator that you might be missing sales opportunities. In other words, you should have more inventory, you should have more stock, so you're able to provide that to the customers, whether it's a retail customer or a distributor, a distribution channel that you're using. Sorry, I'll pause here on operating ratios if there are any questions.
Yeah, Linda does. Since I am a sole proprietor, are my assets everything I own, even personally?
Linda, that's a good question. You're a sole proprietor, and you really should think about your assets only from the standpoint of what's relevant to the business. Now, this kind of is a sort of a little convoluted question, because if you set up your business as an LLC or as a corporation and not as a sole proprietorship, then you would be able to manage your assets related to your business separately from your personal assets. You should, we always advise people, don't commingle your personal assets and your personal liabilities with your business. So calculating these ratios should be on your business assets and your business liabilities. Let me go to the next set of.
I got two more questions that just.
Oh, okay, sorry,
popped up.
yes.
That's okay. How does this apply to businesses that are based on service rather than inventory of goods?
So the inventory turnover ratio does not apply to any business that is just services. They don't carry inventory. That only matters for when you have assets.
Can you maybe go back and repeat that formula for the operating profit and the inventory? Can you show those ratios again?
Yes.
How they're calculated? Thanks.
So the operating profit ratio is on your profit and loss statement, on your P&L. You have your sales dollars, your net sales dollars or revenue, and you have something called operating profit before taxes or miscellaneous income on your P&L. If you divide the profit by the sales, profit dollars by the sales dollars, and that ratio in a percentage is your operating profit percent ratio. The inventory turnover ratio takes two numbers, one from your balance sheet and one from your P&L. And that ratio calculation is dividing the average inventory dollars by your cost of goods. And because you do this calculation, you should do this on an annual basis set of numbers. The average inventory is, you take your balance sheet at the start of the year and then take the balance sheet at the end of the year. Take those two numbers, do an average of those numbers, take that dollar number and then divide it by the full year's cost of goods, which is on your annual P&L. And I say annual for this ratio is, it's a 12-month period. So you don't have to do it at the start of a given year and at the end of a given year. You could do it at, like if you're right now, for example, let's say your books have been closed and your accountant has given you your P&L through the second quarter, which, let's say your year runs from January through December, your second quarter ended in June. So you could look at the inventory turn ratio for this year in June and then look at what it was last year in June. So you look at your balance sheet, over a 12-month period. Which 12 months you pick, that's up to you.
I have another question. Is there a goal percentage that you should be at for an operating profit?
That actually, you can set your own goals. You can look at what your industry does, say in your region, and how long you've been in business to decide what that goal should be. But, there are businesses that make very low percentage as a profit. Some make very high. So there is no one single answer. It depends on what business you're in.
All right, that's all I have for now.
Okay, thank you. Okay, now the third set is called profitability ratios. Now we've talked one of the profitability ratios in that operating ratios. So it's really taking that one step further. And in the profitability ratio area, there are 3 ratios that you should always keep an eye on. The first one is called the gross profit margin. So the gross profit margin is take your net sales on your P&L, subtract the cost of goods sold. That's called gross profit or gross margin. And if you divide it by the revenues, that gives you the gross profit margin. Now, the difference between gross profit margin and the operating profit margin is the operating profit margin, I said, look at your P&L for the operating profit. The operating profit removes other expenses in addition to cost of goods sold from the number. And those additional expenses are your selling, administrative, and overhead expenses. Whereas the gross profit margin is very specifically related to the sales that happen related to your product. So your gross profit margin will always have to be more than your operating profit margin %, because from the gross profit margin, you would subtract out your selling expenses, etc., your administrative expenses. And your gross profit margin, you should make sure that it is either stable or it should be increasing over time. Because over time, as your sales increase, you should be assuming you're doing a good job of marketing and pricing, etc. Your gross profit margin should never be going down. If it's going down, it means you're essentially becoming less profitable in the marketplace. Then there is another profitability ratio called net profit margin. So on your P&L, on your profit and loss statement, there are 3 profit numbers. One is the gross profit, then it's the operating profit, and then there is net profit, which is below on your P&L from your operating profit. And net profit margin takes your revenues and it takes your earnings after taxes. So when you take your operating profit from that, if you subtract out the taxes, because when you make profit, you have to pay taxes. When you subtract out the taxes, you get earnings after taxes. And if you divide that by the total revenue, that's your net profit margin. So if, like the other 2, if your net profit margin declines year over year, or it is less than what the net profit margin is in your industry, the message from this ratio is look at your costs, look at your management effectiveness, and essentially over time you are going to go out of business. So keep an eye on the net profit margin ratio. The third profitability ratio, just like that inventory turnover, it takes numbers. You look at numbers on the balance sheet and the income statement, the P&L. It's called return on assets. Return on assets is an acronym people use all over the place called ROA. ROA measures for every asset dollar that is invested in the business, how much profit is generated from each asset dollar. And how do you calculate that? You calculate that by taking the net income, which you get from your P&L, divided by the average assets for the time period that you're calculating the ROA. So if you're doing it, say your annual ROA, you would look at your balance sheet at the start of the year, then you look at the balance sheet at the end of the year and look at your assets of those 2, average the 2 numbers, and then you take your net income from your P&L and divide that by the average assets, and you'll get your ROA. So what should your ROA be? You're wondering. Well, it depends. Sorry, in these financial indicators, the answers are always usually it depends. Service businesses usually have a higher ROA than a manufacturing business. However, it's more important to understand what is your industry ROA, and then decide what's a good goal to have for your ROA. So that's profitability ratios. Any questions on profitability ratios?
We have no posted questions at this time.
Okay, thank you. So I'm on to my last set of ratios, which are called working capital ratios. Working capital ratios, there are many, but we'll just talk about two of them. One is called the gross working capital ratio. How do you calculate that? This is very simple. You take your current assets minus your current liabilities, and it tells you this is the working capital that you have. It's just two little calculation of two numbers. The more working capital you have, the less you will have to borrow. Because in every business life cycle, there's always a time when, cash, they say, is king. You may have to borrow. But the higher your gross working capital, the better it is, because when the time comes to borrow, you will not have to go to a banker or to friends and family or etc. to borrow. So very simple number to look at. The second working capital ratio is called debt to net worth. What is debt to net worth? These numbers are available on your balance sheet. If you look at a balance sheet, you look at your total liabilities. On a balance sheet, on one side, the left-hand side are the assets, on the right-hand side are the liabilities and the shareholders' equity. On a balance sheet, the assets and the sum of liabilities and shareholders' equity, those two match. They're identical. That's why it's a balance sheet. If you just look at the the right-hand side of your balance sheet, you'll see a number that says your total liabilities, and you'll also see a number that gives you the shareholders' equity, the total equity. And if you divide one by the other, you'll get this debt to net worth ratio. Net worth is the shareholders' equity is also called net worth. So if your debt ratio is less than 1 or 1.5, that's very good. It says you are not as reliant on borrowing. The higher this ratio, it says you are dependent on more money coming to you from where you're borrowing the money, as opposed to your own investment, the business's own investment in the operations of the business. So I hope I haven't gone too fast, but I just wanted you to know what are some simple high-level numbers which you can look at and calculate them and look at the health of your business. Any questions on working capital ratios?
I don't have any posted questions at this point. Do you have another slide, or is this your last slide?
This is my last slide.
Okay, great. I have Debbie Dobbins from East Cambridge Savings Bank here, and she is going to talk about what these ratios mean to the bank. And then I'd like to encourage you to please put questions in the Q&A tab for either Ramesh or for any of our representatives from East Cambridge Savings Bank. So go ahead, Debbie. Oh, you're muted, sorry.
Sorry, thank you. Thank you, Ramesh. That was a very good explanation. Yeah, so all of those numbers are numbers that the bank would be looking at when they were, should they be trying to determine if a borrower is a good prospect. And I think one of the points that I would want to underscore is that most of those ratios should be looked at in the context of the industry in which the business is functioning, because they vary hugely from industry to industry. For example, in the in financial services, there tends to be high leverage ratios, total debt to net worth. In a business that has a lot of fixed assets, there would be, the profitability ratios would be very different from a service business or a finance company. So it's really important to have some perspective on where your industry, how your company is performing relative to your industry. As you might imagine, a bank is going to focus very much on the cash flow that's generated. And one of the ratios that we didn't talk about today, but maybe is for future sessions, or we're happy to talk to you offline, is the debt service coverage ratio, which a bank would look at. So it would take the free cash flow number, which is basically net operating income before interest and depreciation, to what the debt service requirements are for the debt that's being proposed or that is currently on the balance sheet. And that's called, as I said, debt service coverage ratio. And that's the number that a bank will focus on most frequently. But all those other numbers are important, and they would be, when an analyst was looking at the business, they would be commenting on trends, on how the business is performing relative to the industry. So, yeah, this was a great primer in balance sheet and income statement ratios, and I'm glad to take any further questions. I think that's kind of what I would have to say generically about ratios.
Okay. Yeah, I do have some questions. I'm not sure, whoever wants to field these questions, please speak in.
Okay.
If it's Debbie, Johnny, or Ramesh. How do you find your industry ratios?
Good question. There are guides. I don't happen to know the name of them, but what you want to look up is your SIC code, a standard industrial code, I think it's called. And
Yeah.
Ramesh, can you answer that question?
Yeah, yes, Debbie, yes. So there are many sources, like Debbie says. One, while I was reading the question, I was going to put in the chat, but I obviously don't read and write fast enough. There's one website called readyratios.com, readyratios.com, sorry. It gives you all industry financial ratios for benchmarking, and it if you just Google that, you'll just see, just on the Google search, you'll get the 5 years worth of ratios, and you can view as many ratios. Another good source is valuationresources.com. It gives you industry financial ratios for over 900 industries. But as Debbie said, if you know your industry code, in which sector your business falls, you should be able to. And then also there's corporatefinanceinstitute.com. There are many. Actually, if you just, I always say Dr. Google tells you a lot more very quickly.
That's a good one. I like that, Dr. Google.
Okay, I have 3 questions on the same thing. Can you please restate the formula for the debt service coverage ratio?
Sure. So you take net operating income and you calculate what's called EBITDA, earnings before interest, taxes, and depreciation and amortization. So you start with a net operating income, you add back interest and add back depreciation and amortization, and that gets you, let's say that gets you 125,000. Then you calculate what the debt payments are going to be. So usually they're principal and well, it depends. If you're doing an interest-only line of credit, it's only interest on whatever line of credit. But if you're doing a term debt, it's going to be principal and interest. So let's say your debt payments are going to be $100,000 a year. So you have an EBITDA number of 125 and you have debt payments of 120. That gives you a ratio of 1.25 times. And that's typical of what a bank is looking at for a minimum debt service coverage ratio on a business loan, business term loan. So the EBITDA number is in the numerator and the debt payment number is in the denominator.
I did like, not to throw it, very hard to make jokes during such a topic like financial ratios, but I know it was a typo. The person who wrote that called it the debt ratio, DEAT. We don't want your ratios to be portending death.
Yeah, somebody asked about if we asked if we could write that down. What I can do, Debbie, can you email me that information and I will make sure that gets into the follow-up email after this webinar,
Sure.
so that folks have that information.
I'd be glad to do it, but I also would follow Ramesh and say that Dr. Google will have the answer to that one too.
Okay, great.
Yes, absolutely. Yes.
Okay. Okay, well, I do not have any more posted questions. So I definitely would like to encourage everyone to consider working with the SCORE mentor. All SCORE chapters have got a mentor that can help in this topic and help you understand it specifically for your business. And I also encourage you to reach out to East Cambridge Savings Bank with any questions you might have for them. Did you have any closing comments?
Teresa, what I was thinking, if someone has, been in business for at least, 2 or 3 years and they want to sort of sit down, with me, with the balance sheet and income statement and do some calculations, or they've done the calculation and they want to discuss, from a strategy standpoint, either marketing or operations, what is the message that the ratios are giving them, and they want to talk about that and brainstorm. I'd be happy to, if they go into the SCORE Boston site, they could try book an appointment if they like.
Okay, great. Yeah, and I have, and I will make sure I put it in there again. You can also email me at outreach@scoreboston.org, and I will try and get you connected with your right chapter as well. Debbie or Johnny, do you have any closing comments?
I don't think so, but I'll just put in a plug for community banks and East Cambridge Savings Bank in particular, and people like Johnny and me who are out trying to help businesses in our communities where we like to think we're very responsive and our service is very personal. And unless you need the big balance sheet of a big bank, you're often better served at community banks such as East Cambridge Savings Bank.
Great. Thank you very much. Well, I want to thank Ramesh and our sponsor, East Cambridge Savings Bank, for this webinar. And I want to thank all of you for taking the time to join us during your lunch break. And we hope to see you at the next webinar. Thank you.
Thank you.
Thank you.